In this video, we'll compare and contrast the common size balance sheet for McDonald's, stock symbol MCD, and Johnson & Johnson, stock symbol JNJ, over the period 2012 to 2016. If we're looking at a common size balance sheet, takes all the values in a balance sheet and divides them by total assets. So all these numbers here are a percent of total assets. If we look back at the actual financial statements for the two firms, the size of the companies is really different. McDonald's roughly $35 billion of total assets, and Johnson & Johnson's is 4 times the size. But by rendering everything as a percent of whatever assets you have, it facilitates comparisons between the two firms, because now we're looking at percent of total assets rather than a dollar amount. One of the things that leaps out at us, first line up here in the assets, is the cash at Johnson & Johnson is very high compared to the cash at McDonald's. So they have a lot of cash. Almost a third of their balance sheet is cash or cash equivalents. We also see that Johnson & Johnson has a lot of receivables. As a percent of assets, about twice as high as McDonald's. But here's the next really big leap. Inventory is negligible at McDonald's. They have a just-in-time inventory system. They have, over the years, tried to perfect the idea of holding as little inventory as possible and churning it over very, very quickly. But that's the fast food business. You can't keep frozen hamburger patties around for forever. Johnson & Johnson, on the other hand, has a fairly large investment in inventory. The box of Band-Aids doesn't go bad on the shelf like a head of lettuce would at a McDonald's or a McDonald's franchise. All right, so what that leads to is that the current assets at McDonald's are a small fraction of total assets, running in the, call it 15% range. If we go over here and look at the J&J model, it's closer to 40-45%. And then the next big difference is net fixed assets. McDonald's typically owns, well, I believe the number is roughly half of the franchise restaurants. They actually own the land and or the building and then lease it to the franchisee. Of course, they're going to own their own, when they own a company owned and operated restaurant, they're going to own the land and building. So they have a lot of fixed assets relative to Johnson & Johnson. And we also see the other non-current assets in here. Those can be a lot of things, and it's very high over here for Johnson & Johnson. And if we actually go into the Johnson & Johnson financial statements, we can actually dig out an explanation for why they have such a large amount in the intangible assets. These non-current assets include things like patents on products and trademarks, customer relations, and goodwill from purchases of other firms. So they provide a detailed schedule in the 10K, which I'm just pulling it up here to show you where to go and look. This is from their latest 10K filing. If you wanted to know more about what's actually built into there, the ratios don't tell you anything other than where you need to go look a little bit further. So we see $27 billion of intangible assets in year ending 12/31/2016, or the 2016 calendar year. See that a whole chunk of it is patents, less amortization, customer relations and intangibles. I'm not sure what that is, but that's a pretty large amount. And the trademarks. So that and the goodwill schedule give you some idea of where they came up with these large numbers that between them total about $60 billion in 2016. All right, so back to the ratios. Again, when you see big differences between these companies, or you see big numbers that don't seem to make sense, the first step is to go into a 10K and see if they have an explanation for it. Because the ratios don't tell you anything. They tell you what to look for when you dig a little deeper. We go over the liability side. Liabilities for Johnson & Johnson are roughly half of total assets. And we see that the accounts payable, short-term debt, and other current liabilities, which are often tax assets, or tax liabilities rather, about 20%. Long-term debt, fairly reasonable. Now we start comparing that with McDonald's. As a percent of assets, it's gotten much higher over here at McDonald's because of the way the assets are changing, and also the actual dollar amounts. If we go over here at McDonald's, we can see that they are borrowing money, long-term debt. It was about 14, 15 billion here, and they have increased that by about 80%. So you're looking at now $26 billion of debt has been added, long-term debt. They have relatively little or no short-term debt. And at the same time, the firm has been buying back shares of stock. So actually what you see them doing is trading debt for equity. And that's a deliberate attempt to go out there and leverage the company up a little bit further. We can argue, reasonable people can argue whether that's too much leverage or not too much leverage. The point here is to point you in a direction where you would go looking at why they're doing that. And it'd be one thing if this was because McDonald's was losing money. Their retained earnings actually getting higher. They are making money and they don't pay it all out, but they are deliberately increasing the treasury stock, and that's some might say that's excessive.